Don't you just hate fees for investing? Every little bit of cash just gets chipped away at, and every person wants their cut of your hard-earned money. But don't give up too soon. There are a few tricks that we can use as investors to save ourselves thousands of pounds and create better long-term results.
Show me the money, show me the money.
And that's why I've just put together what I think is one of the cheapest global ETF portfolios that you can invest in today, using funds that are simple to find and should be available on most popular investment apps and platforms. This means that more money stays in your pocket and less to those fat cats on Wall Street.
Take that, you greedy fat cats.
As much as I love those global index funds which cover most of the world and let you invest your money into almost every public company you can think of, they do come with ongoing costs and charges. For example, let's compare a couple and you'll see what I mean. One of the most popular and a great benchmark is Vanguard's FTSE All-World ETF, which trades under the ticker symbol VWRL. It's got ongoing charges of 0.22% per year, meaning that a £1,000 investment costs you £2.20 a year in charges if we assume nothing else changes. However, compare this to Vanguard's S&P 500 or even the FTSE 100 funds, and you'll see the costs are only 0.07%, or around 70p per year on a £1,000 investment. Now, that doesn't sound like much of a difference, does it? But look at it in percentage terms. The global fund is more than 3 times more expensive than those other US and UK funds, which then got me thinking, why don't I put together a global fund myself using different low-cost ETFs to save as much money as possible? It takes just a little bit more effort, but you could end up saving thousands over the long term. Let me show you how. First, let's work out a plan. So I want to make sure I've got a portfolio that's somewhat similar to the FTSE All-World ETF or even the FTSE All-Cap. Something that covers most of the world as best as we can. So that's everything from North America, here in the UK, the rest of Europe, and then Asia too, including the emerging markets and other important markets like Japan. The FTSE index breaks down the world into the following categories, and with these weightings, it's all based on the current market cap. So the larger the stock market in each country, the larger the weighting. For example, because the US has the largest stock market in the world, they'll take up over 60% of the weighting, and then the UK market makes up around the 4% mark. We're only a small fish in a very big pond. In short, for every £100 you invest, £60 would go to the US companies, £6 to Japan, £4 to the UK, etc. Nice and easy. Right, so the next step is finding ETFs that we can use to match each and every part of the world. There are thousands out there to choose from, so let's get to work. I want to stick to low-cost passive funds for this portfolio, as we want to keep our costs as low as possible, and we want to use providers who are already trusted as well. Now, I've already done all the hard work for us, so there's no need to waste time. Here's what I've chosen and how much weight we roughly need to use to get one of the cheapest DIY global funds you can buy here in the UK. First up, the largest market, the US and North America. Let's not forget about little old Canada sitting up there too.
Greetings from Canada.
For this fund, I've chosen the Vanguard FTSE North American ETF. It's got 674 companies inside of it, and it's got a fee of 0.1%. I'll have all of this on one page near the end of the video, so don't worry about pausing as we get going along. Next up is the second largest market, Japan. Now, if you're looking at ETFs, you'll see that there are loads of funds that include Japan inside the Pacific region as a whole, or even exclude it. So you can technically play this one how you like it, but for this video I'm going to break them all out and stick with a Japan only fund. After doing some digging again, I'm going to stick with a tried and trusted Vanguard one, the FTSE Japan ETF. This fund holds 504 companies and comes in at a respectable 0.15% annual management charge. I'll tell you the weighting at the end, don't forget. Coming up to the next largest market, we need to deal with the UK and Europe. This is another one that we could make simpler by just having one single European ETF that includes the UK, but because I'm trying to be as frugal as possible, it will be a tiny bit cheaper to make it ourselves. So I've gone with the iShares Core FTSE 100 ETF here, an offering from BlackRock that's really popular, covering the biggest companies in the UK. You could definitely go for a wider fund or even add the FTSE 250 if you want to as well, but for now we'll stick with the big boys who really make those moves. 3 more markets to sort out then. The rest of Europe, emerging markets, and then the rest of Asia too, excluding Japan, because we've already dealt with that one. Europe is an easy one to cover off. I ended up choosing another Vanguard fund. Other providers are available, but these ones are just very good value and also have a huge amount of liquidity too, because the fund size is just so big. The fund I chose is the FTSE Developed Europe, excluding UK. This has 483 companies inside it with an ongoing charge of 0.1%. Moving on to the final two, for the emerging markets, this is another popular fund and one I actually own in my own Vanguard account. the FTSE Emerging Markets ETF. This one is the largest fund in the group in terms of number of companies invested in. There's a total number of 1,873 holdings and ongoing charges of 0.22%. Emerging markets, I think, are always a bit of a missed opportunity for some investors who just stick with their home markets, as there's a huge world out there and some extremely fast growing economies with billions of people moving them forward. Just quickly, if you're enjoying the video and you want more UK focused finance content, please do me a huge favour and hit the like button and consider leaving a comment below too. It really helps out small channels like mine find more people like you. Otherwise you'll have to put up with some of the crazier voices from across the pond. America. Don't worry, we love you really. Anyway, let's get back to the video. And finally, last but not least, we need to include the Asian market without Japan. For this one, I've chosen the Vanguard FTSE Developed Asia x Japan with holdings of 398 companies and ongoing costs of 0.15%. Bear in mind that for all of these funds, the costs are not factoring in any of the account fees or transaction fees that you might have to deal with. This is all just the cost of the funds themselves. You'll need to check with your investment platform to see what they actually charge outside of this. If you're smart though, you might be able to get away with little or no fees, but I'll touch on that one later. So drum roll please, here's what the portfolio looks like then, and I'll put this up on screen now with all of the weightings that I've allocated to each one. Bear in mind that I've rounded up and down to make it add up to 100% to make the most of any money invested. The average fee across all of the funds is 0.13%, and the average weighted fee, which is the most important measure, is 0.132%. We need to use a weighted average because we're putting different amounts of money into different funds. The big question then is, how much does this really make a difference compared to just using a single global fund? Well, let me show you and then you can make up your own mind whether or not doing something like this is a good use of your time. Let's run two examples. Both the same amounts of money, we'll say £20,000 invested over 30 years, getting 10% a year return on average. Then in the second scenario, rather than getting 10% return, we'll get slightly less, and the difference in fees from the FTSE All World Fund and our own DIY fund is about 0.09%. So not much difference at all, but let's see what the effect is over 30 years on our money. In the first example, we end up with 396,747 and 99p, a pretty nice chunk of change. Now, what about if we had slightly more expensive fees and used the global fund? Well, in this scenario, we're getting 9.91% per year instead of the 10. So over 30 years, this gets us to £386,264 and 91 pence. The difference is £10,483 and 8p, or around £350 per year difference, which is around £29 a month. It doesn't sound like much money, but I'm sure you'd like an extra 10k if that was for your retirement, or you can take a nice little holiday. So now the ball's in your court. It's not all plain sailing though, just a couple of caveats worth mentioning here though. All of these ETFs I selected provide you dividend payments, which means that you'll want to work out what to do with your money, either reinvesting it or taking it out and choosing something else to do with your money. Ideally, you'd want to have all of these funds inside a stocks and shares ISA too to protect you from both capital gains tax and dividend tax. Otherwise, you may end up with a sizable portfolio that could end up with multiple visits from the taxman. Make sure to keep yourself updated with all of the latest tax-free allowances you get each year, which is currently $12,300 for capital gains and £2,000 a year for dividends. Secondly, with a DIY portfolio like this over the years, you'll need to rebalance it somehow if you want to maintain those weightings that you've originally set at the beginning. You'll have to sell funds which have overperformed and then buy more into the funds that have underperformed. So all of this is going to cost you your time and possibly money if you've got an investment platform that charges for doing things like that. I know companies like Hargreaves Lansdown and AJ Bell and many others would treat an ETF trade just like buying any other share, so just be careful on that one. And don't forget, like I said, there are many other providers out there. I've mainly stuck to Vanguard funds, but if you do your own research, you might find ones from trusted names that also work in exactly the same way. Now though, the big decisions are up to you. Is it worth the effort to make your own portfolio, or do you just stick with a couple of different funds and pay the premium on fees to save yourself all of the hassle? Let me know in the comment section below if you change anything and what you'd be going with. Remember, I'm no professional financial advisor, I'm just sharing my own thoughts and opinions, so please do seek out professional help if you need it. And speaking of different investing platforms, if you are needing to find a new broker or a new stocks and shares ISA provider, please feel free to watch this next video, which is one of my most popular ones, looking at all of the best platforms for 2022. I'll also leave my own portfolio update videos in the comment section below. Feel free to check those ones out if you do want maybe a bit of inspiration. Anyway, thanks so much for watching the video. Please drop me a big like if you've enjoyed it. Subscribe for many more, and I will see you in the next one. But as always, happy investing.